All right, we are back for a special episode of Me and Money today, our first ever guest. We have the pleasure of having Tony Steuer here with us today to talk a little bit more about cash value life insurance and just life insurance in general. I know that in the last episode we had talked, about some of the things that Elliott and I see, where maybe clients have just the wrong insurance or maybe too much of a certain type of insurance when they walk into our offices with their proverbial, pile of paperwork. So, Tony, we're really excited to have you here today to share the other side and some of the cases that maybe you've seen throughout your career and conversations you've had with advisors about cash value life insurance. So, why don't you give our audience just a little background on yourself and how you wound up where you are today, sitting with us here on this podcast.
Well, I'm glad to be here and honored to be the first guest. So a little bit about myself is I started out in the business as a life insurance agent, but I was working predominantly with property and casualty advisors at the time. And I found that a lot of their clients wanted more of a consultation than a sales process. So California has a license, a life and disability insurance analyst, which allows you to charge a fee for doing life insurance consulting work. So I got that license and I got connected with some financial planners, and I found that there was a real demand for financial planners and wealth managers to have people come in and say, okay, well, is this policy any good? What do we do with it? Do we need to make changes? How can we unwind it? So I did that for the best part of 30 years. I got into doing some litigation consulting, working with trust officers, kind of the same thing as we're managing this life insurance policy where the trustee, we don't know what this product really is. So I started doing that. I started doing education work. I was with the California Department of Insurance Curriculum Board for almost a decade, and really talking about these issues and what do producers know, and really trying to get information out there in the market. So I also got some experience with best practices as well. And a lot of it really came down to is the understanding and the communication around insurance policies is, for the most part, they're bought by people who don't understand what they're buying, sold by people who don't really understand what they're selling, designed by insurance companies who don't really understand what they're designing, and regulated by regulators who don't really understand what they're regulating. So that's where I am, and that's how I got here.
Well, I mean, we're going to certainly have to recover from that, but I'm sure, our consumer, side clients and even myself, I mean, that kind of scares you, when you hear like there's all these people in this chain of, a product that don't really know what's going on. So, Elliott, where do you want to start with your questions? Because I know you were just at a conference all about life insurance and estate planning. So where do you want to start today?
Yeah, maybe Tony, you could kick things off with just when does maybe explain what permanent life insurance is, and then when does it generally make sense? What situations do you see? And then from there we can go into, if you have a policy already, what can you do with it? But let's start out at a very basic high level.
Well, at a very basic high level is the name is a giveaway to who actually needs it. It's if you have a permanent need for life insurance. If you have a need for a specific number of years, then you want to think about a term life insurance, which matches the name. People have put so many things into whole life insurance, universal life insurance, variable life insurance, equity index life insurance. You can watch TikTok and, you can be your own banker, you can have it as an investment. You guys may have heard about it being an asset class. Well, if you look at a life insurance policy, the very first thing it says on the front page is this is an insurance contract. And people need to remember that is that despite all these different things, if you buy a cash value policy, at the end of the day, you're buying an insurance policy and you're paying for the cost of insurance. So so you have to make sure that your family or your business or whatever has a permanent need for the life insurance. Now, one other quick note, and this is, I think, one of the things that we'll get into, is that permanent life insurance isn't always permanent. And that's why it's really important to understand the product for you and your clients.
Hey, Tony, can you talk about, when you talk about permanent, who are those people? What are some examples of people who might need insurance for their entire lives?
So one of the, things that I saw most commonly are parents with special needs children who are never going to be able to support themselves. So the life insurance policies are set aside in a special needs trust so that there's always money there to take care of the special needs child so it doesn't impact the rest of the estate. Planning for potential estate tax needs or liquidity is another usage because that's not going to go away, is having some money on hand. So where I've seen some large permanent life insurance policies are, for example, with people who are heavy in real estate investment. So if they pass away, they have illiquid assets. So the life insurance gives them some liquidity so you don't have to have distress sales on the real estate that's owned by the estate. Some of the other needs, sometimes business needs, but that's still a temporary need because at the end of the day, people don't stay in their business forever. They age out, in their 70s. Sometimes, we know founders who've worked into their 80s, but they do retire at some point. So, in my estimation, there's not a lot of permanent needs out there.
Okay, so we primarily have special needs trusts, estate liquidity issues, or just liquidity issues generally, people with high real estate values, that sort of thing.
Yeah, or you have middle class people who, they invest everything in housing, and flipping houses or whatever. So, they do have a lot of their money tied up in illiquid assets.
Yeah. Okay, that sounds good. So those would be situations where it makes sense potentially to have some permanent life insurance. You threw out a lot of different names of whole life, variable, universal. Do you want to briefly talk about the differences between those just before we get into what happens if you have a policy? And that might help people identify what type of policy do they have.
Yeah, that's an excellent question because that's what we, in my introduction is people don't really understand even the type of policy they have. And they're always surprised when you give them a report and say, well, this is what you actually have. So a whole life policy, the original concept is that the values, you have guaranteed value. So you have a guaranteed premium, a guaranteed cash value, and that it endows, which means the cash value equals the death benefit at maturity. And I want to make a note there because we talk about permanent life insurance, and a lot of permanent policies are not actually permanent. They have a maximum age where they go anywhere from to age 95 to age 120 or age 125. So that's also a misnomer that
Mhm.
permanent life insurance isn't always permanent. So I just want to throw that in there because that gets relevant to the rest of our conversation. So universal life insurance is flexible premium, universal life. So you can change the premium on a policy. You can change the death benefit on a policy. Of course, if you increase the death benefit, you have to go through underwriting, but you can change things. And that was the idea. But those policies have been really disastrous, and we can talk about that in a minute. Variable life, people said, well, I want to get more return than I get on whole life and universal life. So variable life allows you to invest in different sub-accounts that mirror regular sub-accounts. So you might have the Schwab S&P 500, but it's not really the same thing. It's a sub-account that tracks and mirrors Schwab S&P 500. Those policies are regulated by both the SEC and the state insurance regulators. And then you have equity index universal life, which part of it is the producers don't have to have securities licenses to sell them, which was a winning thing in getting the policies pushed aside. And they also have sub-accounts that mirror actual accounts, but with the equity index universal life policies, they made those policies much more complex. They added on all kinds of levers, like they have a cap on the maximum earning rate. They can change the participation rate. So, if the return is 10%, you may only get 80% of that return rate. So they've added on a lot of things. So as you can see in that progression from whole life, which is, like your premium's guaranteed, your death benefit's guaranteed, you're going to have some guaranteed cash value, you may get dividends, to a product where anything goes. So that's kind of the history of the product development of permanent life insurance.
Great. Do you want to talk a little bit about where you've seen universal life go wrong? I mean, you touched on that, and I've seen that in my own practice of, we have this policy and then it's not performing as someone would have expected. And do you want to talk about what happens at that point and how they got to that point?
Yeah, so the statistic on universal life, it's estimated that between 80 to 90% of the original batch of universal life policies sold in the 1980s and 1990s are going to lapse before maturity. And what that means is that the premium that's being paid on the policies is not sufficient to carry the policies to their maturity, which is usually age 95 to 100. Part of the reason is those policies were sold with interest rates of around 8%. Now, for the better part of the last decade, insurance companies were earning 3 to 4% on their own investments, sometimes a little bit higher. So, the insurance companies had to reduce interest rates by quite a bit on those policies, and a reduction in interest rates means that there's less cash value buildup, which means there's more amount at risk to the insurance companies. So to back up there, a good way to look at this is, let's say you have a policy with $100,000 death benefit. In 10 years, your cash value is projected to be $20,000. The remainder is, and this is a misnomer about the cash value, on a whole life and universal life policy, it's a reserve on a policy. It's not a separate policy. So what happens is, as a reserve, it's reduces the net amount risk to the insurance company. So with that $100,000 example and a $20,000 cash value, $80,000 is at risk to the insurance company, and that's what they charge you the mortality costs on for $80,000 of insurance. Now, if there's only $10,000 of cash value, then that means $90,000 is at risk to the insurance company, which means that as you go further, not only are you not earning more interest on the cash value, you also have higher costs of insurance because there's more risk to the insurance company. So that's a double whammy there. Now, the other thing that's happened is, because if the insurance company has a guaranteed interest rate of 4.5% that they're obligated to pay on this policy and credit to the policy, but they're earning 4% or 5% on their own investments, they got to come up with that money somewhere, because otherwise they're not going to be profitable. They're not going to have adequate capital. So they have to increase their costs of insurance. And that creates an even more magnified situation, because remember, the net amount of risk to the insurance company is increasing. And not only is it increasing at a greater rate than they anticipated, they have to charge more on an increasing amount. So you have this whole compounding snowball effect. So if you ever have taken a look, and we can talk about in-force illustrations, in a minute, but if you've ever taken a look at one of those, you'll see it looks like a hill. The cash value sort of climbs, and then all of a sudden it just plummets, and it's plummeting because of those factors. So that's a reason.
So what I'm hearing then is, if you have anything but a whole life policy, you should be regularly checking up on your policies. Is that a good way to put it?
That's an excellent way to put it. And one caveat on the whole life policies is, if you have a policy loan, you should also be checking that out.
That is a good point as well. So why don't you talk us through then, how often should you be looking at policies, and what should you be looking for? Like, let's say I'm listening to this podcast and I have some sort of permanent, and I'll use air quotes there, permanent policy, or at least I think it's permanent. What should I be doing?
Well, the first thing you should be doing is requesting what's called an in-force illustration. And Elliott, I can get you some sample letters if you want to post them in the show notes, or listeners can just email me and I'll send them, a sample in-force illustration letter. So what an in-force illustration letter does is it requests something called an in-force illustration from the insurance company, which is a projection of values using current values. So it uses today's cash value, today's premium, today's interest rate, and today's cost of insurance. So it shows what's going to happen based on what's really happened versus the original sales illustration, which was just a guess of what might happen. So again, it's still a little bit of a guess, but it's using today's values. So it's going to be a little more accurate. And, my suggestion is, well, if you spot that there's an issue, and I'll talk about that in a second, that you want to order them, annually. If everything looks okay, then you want to order them every 2 to 3 years to keep an eye on things, especially, it was really important while interest rates were really low. to take a closer look at them. But what you want to spot is the current premium sufficient to carry the death benefit to the maximum age or the maturity date? And if it looks really close, if it shows that there's only going to be $1 of cash value at age 95, assuming it's a to age 95 policy, well, then there's a weakness there. Or you'll see that the cash value will only continue the policy till age 90. Well, then you've got a problem. So what I tend to do is I request 2 enforced illustrations from the company to start off with. One is, based on a current premium and current assumptions, how's it going to go? And then I say, what is the premium required to carry the policy to maturity? And see how different those are. And then that gives you the starting point for a conversation with your client.
Great. So you're asking for 2 illustrations every year to start, but then every maybe 2 to 3 years if things are looking okay?
Yeah, that's my recommendation.
Okay. Are there other things that people should be looking at in those enforced illustrations, or anything people should be aware of that when they ask for an enforced illustration that they might get met with either resistance or a new sale pitch or something else?
Those are all things that happen. One is some companies are great. You request the enforced illustration, they send it to you, they send you exactly what you're looking for. That's a first warning sign, is if you don't get what you asked for from the insurance company. The other thing that you want to do is you want to make sure they send you the full illustration. And how you can tell is there's a page count at the bottom. It'll say, 15 pages. So you want to make sure you actually get 15 pages back from the insurance company. If it goes through some insurance agents, you might find that you get pages 1 through 5, or you may get certain pages. So that's another warning sign. So you want to make sure you get a full and complete illustration. And then you want to make sure you get what you're asking for. So, remember, I'm asking for 2 different things. You may get one. So if you don't get the other, you have to be persistent. Now, remember that insurance companies have to send these out by regulation. However, they don't like to send them out if there's a weakness in a policy. Some companies don't mind because they want to make things right, or at least give their policy owners a chance. Now, that raises the question of why insurance companies aren't required by law to send these out. Anyway, but that's a whole separate discussion that we went through with the California Department of Insurance, and we couldn't get that accomplished. But that's what you want to look for, is to see if there's some resistance. The other thing is you want to think about, okay, does the client want to make some withdrawals? And you want to have an enforced illustration showing those potential withdrawals. Or if the client's already made withdrawals, maybe take a look at that. The biggest challenge that I've seen with policies, and this includes whole life policies, are policy loans. Policy loans can really erode the value of a policy, especially if the policy owner is continuing to borrow interest on a policy loan. So you have a compounding situation. And when there's no cash value in the contract, then the policy will terminate, even if it's a whole life policy. And what can happen there is you can have a phantom income tax gain. So let's say you have a $50,000 cost basis. That's the sum of premiums paid into the policy. You have a policy loan when it terminates of $100,000. You'll have a phantom income tax gain on the difference between the value received and your cost basis. So that's why it's really important, especially with a policy loan, to see what's going on with it.
So just to break that down a little bit further, in this case, I've paid $50,000 into the policy. I see that I've got some good cash value, and I say, hey, I want to borrow from that policy. So I'm going to take out 10, 20 grand, whatever it is. And I'm like, oh, I'm good. But then as time goes on, I'm paying interest on that loan, right? And
Exactly.
then on top of that, the cost of insurance is rising as I get older. So there's less cash value and the cost is going up, right?
Well, so for policy loans, that works a little bit different.
Okay.
Is because you've borrowed money from the company, it doesn't impact the reserve level of
Okay.
the company. So for calculating the cost of insurance, they still assume that you have that full amount of value. So it keeps the net amount at risk. If you were taking withdrawal, it would increase the net amount risk. But if you're taking loan, and that's because you're paying loan interest on it, That's why the company is charging loan interest, because you're borrowing some of the reserve, and that goes against the whole TikTok thing. You're not your own banker. You're not borrowing your own money. You're borrowing money from your policy, from the insurance company. That's why they're charging you interest. If you were borrowing money from yourself, you wouldn't pay yourself interest.
Yeah,
So,
that's a good point. Okay. So loans can become an issue. I want to go back for a moment to you get an in-force illustration. Let's say I'm listening to this, and let's go down two paths. One, it looks good, and another, it doesn't look so good. What are my options at that point?
well, your options are, if everything looks good and your client still has a need for life insurance. So when I did a evaluation with a financial planner, that's always the first question we'd go through. It's like, okay, well, what is the client's needs? And that's where you always want to start. Is like, okay, does the client even need this insurance? Well, if the client doesn't need the insurance, and you go, okay, well, can the client just surrender it? And what are the, what's the alternative to surrendering it? So that's pretty easy. Or if everything looks good and the client still needs the insurance, well, then you just keep everything the same and keep monitoring it. Now, if things don't look good, so if you recall, I mentioned you get two in-force illustrations, one showing the premium that needs to be paid to continue the policy to age whatever the maturity date is. You can, go through that with your client and say, okay, well, if you still need the life insurance, do you want to pay this additional premium? And if the client says no, which is quite often the case because they want to pay the same premium they've always been paying, then you can get another in-force illustration. And if it's a universal life, type policy, then you can reduce the death benefit to, fit that premium. But then that's where you start getting into like, okay, well, what do you want to do? Is this policy important to you? You can also do what's called a 1035 tax-free exchange to a different permanent life insurance policy that may be a little more stable for your client. So,
Yeah.
That's where it gets a little tricky, and you have to explore all the options.
Yeah. And I think that, and Tony, correct me if I'm wrong, that could also be an option if things are looking good for the policy as well. That if you're healthy enough to qualify for a new policy, maybe it's repositioning some of the cash value that you've built up into a different type of policy that maybe fits. Maybe you bought it for certainty in the past, that need doesn't exist anymore. It wasn't sold in quite the best way. You could then repurpose it now for things like long-term care benefits or other leverage more of the death benefit potentially. I've seen situations like that. Would you agree with that?
Exactly. That's exactly what I was going to point out. So, is that you can use a 1035 exchange to a combination life insurance, long-term care insurance policy, or you can, as you mentioned, is do a 1035 exchange to a permanent life insurance policy, which has a long-term care insurance rider. And there's some differences in how they're funded and the benefits that you get. But, essentially, you're getting some life insurance and some long-term care insurance, which I found in most cases is usually a need for most clients.
Yeah. So I think that's just an important thing for listeners to keep in mind, that the policy you have today and when you purchased it, that may be different than what you're hoping to do over the next decade or two.
Exactly. Things change. But yeah, the long-term care insurance is always something that comes up. Even if your client has $3 or $4 million of assets, their estate can be depleted pretty quickly, if there's a long-term care event.
Okay, great. What else should people know about permanent life insurance?
That's a great question. And I could go on for hours about it. I wrote a huge book on it. So, I think those are really the important factors but if you have a policy like equity index universal life, is you want to take a look and see if things are changing. Has the company changed the participation rate? There's other tweaks that the company can be made. So, when I do an analysis, we'd also take a look at you can calculate the internal rate of return on the cash value. You can calculate the internal rate of return on the death benefit, because your client, the biggest thing that I ran into is, financial planner would say, okay, well, my client doesn't need the policy. We'd look at everything, okay, the client can surrender it and get $100,000, let's say, or whatever. And the client says, well, I really feel like I need the life insurance. My buddy sold me the policy. He's my golf buddy, and I trust him. And, I want to keep the life insurance policy. So that's the bigger thing that I've found with most financial planners is having that type of conversation with the clients. And what I found sometimes works is, that the planner can say to the client, look, I get it, but you don't need this amount of life insurance. That's where, as we talked about, the rolling over to a combo policy can come in handy. Or you can say to the client, look, you don't need this much insurance. How much insurance can we purchase, or how much insurance can you maintain for your current cash value? So then you would request a different in-force illustration and say, okay, the client has $100,000 cash value. How much death benefit will be supported without any further premiums based upon that cash value? Well, then the client is able to earn more money, of course, on the cash value, but then the client's not putting in more premiums into the policy. So you can strike a happy medium with your client, make your client happy. They get to continue some permanent life insurance, even if it doesn't make a lot of sense. I mean, how familiar does that sound to all the financial planners out there, that your clients do something that doesn't make a lot of sense?
I was chuckling because I
That's
ran
okay.
into that situation. Someone felt sort of obligated to keep a policy or purchase a policy, and I calculated it out. This person could have gifted the agent, I think, like $10,000 and still come out ahead for this specific policy as opposed to buying it. So it's just one of those situations that if you feel some sort of connection, think about your own financial situation. What's in your best interest?
Exactly. But that's a testament to the marketing of
Yeah,
life insurance. It's extremely powerful. So
definitely. Well, if there's nothing else on life insurance, Tony, where can people find you? What sort of resources do you have out there? This is your time to plug.
So people can find me on LinkedIn. Also, you can go to my website, tonysteuer.com. I have a book called Questions and Answers on Life Insurance, which is exactly what it sounds like. And it takes you through pretty much all the questions you can think of about life insurance. And then I have a free resource called the Get Ready Money Club, where people can join. They get a weekly action item to help organize and monitor all areas of their financial lives.
Great. That sounds awesome, Tony. And Matt and I both appreciate you being here today and sharing your expertise and your wisdom on life insurance, because we do all the things that you talked about around life insurance and the issues that go wrong. We see that frequently. And so hopefully someone listening to this today takes what you said to heart and looks at their policy. That's my hope.
Definitely, definitely. So, and I'd invite any listeners, if you have questions, hit me up on LinkedIn with them. I'm glad to share any of these resources with it. And thanks for having me on today, Elliott and Matt. Appreciate it.
Great. Thanks, Tony.